Hello and welcome. In this lecture video, we're going to continue where we left off by finishing our discussion of depreciation and also talking about unearned revenues and accrued expenses as well. Okay? So what we talked about in the last lecture video was depreciation. We said depreciation is done because of the matching principle. We want to match the benefits of using this building. For example, to teach students, to generate tuition revenue, we want to match the cost of purchasing that building with the benefits of that building. Okay, that's per the matching principle. And the process of spreading out the cost of that building that we bought over its useful life is called depreciation. The way we calculate depreciation is we take the asset cost we paid for it, plus any normal and reasonable expenditures to get it ready for use, minus the salvage value, which is what we think we can sell it for at the end of its useful life, divided by the number of years we think we will be able to use it for. Okay? So let's take a look at our depreciation example right over here. On December 1st, Fast Forward purchases equipment for $26,000 cash. It has a useful life of 4 years. Okay, or 48 months. And Fast Forward expects to sell the equipment at the end of its life for $8,000 cash. That is the salvage value. Salvage value, $8,000. So first we have to calculate depreciation. We take the asset cost, $26,000, minus $8,000. In this case, I'm going to divide it by 48 because you can see we purchased this on December 1st, and I need to record 1 month's worth of depreciation. December 1st to December 31st. So I'm just going to divide it by 48 because it's 48 total months. Okay. And what that gives me is $375 per month. Okay. So then my journal entry on 12/31 to recognize depreciation expense. My journal entry to recognize depreciation expense is debit depreciation expense, in this case for $375 because that's 1 month. And then what I'm going to do is credit an account called accumulated depreciation for $375. So I debit depreciation expense and then I credit accumulated depreciation. Okay. Now what we see over here, if we look on the next page, we see that accumulated depreciation is called a Contra asset account. And this is how it looks on the balance sheet. We have our equipment, which falls under plant, property, and equipment. The asset cost of $26,000 less or minus accumulated depreciation gives us book value. This $25,625 is our book value. This book value is the dollar value that comes into calculating total assets. So this book value is the dollar value that comes in here to calculating total assets. Okay? It's called a contra asset account, which means it has the normal balance of a credit. The normal balance is a credit. Okay, it's a contra asset account. So let's talk about how this keeps the accounting equation in balance. Okay, so remember we have our assets equals liabilities plus equity is our accounting equation. How does that journal entry that we just did on the other page, debit depreciation expense, credit accumulated depreciation, how does that relate to the accounting equation? Well, depreciation expense is an expense. It's another expense on the income statement. So remember we take our revenues minus our expenses, gives us our net income. We also know that as expenses go up, equity goes down. Expenses go up, E for equity goes down. So that means something has to happen over here to the liabilities and equity. There's nothing, or liabilities or assets. There's nothing that happens to liabilities. Nothing happens to liabilities here. But assets go down. Now, why do assets go down? Because I didn't credit the asset, did I? I didn't credit equipment. What I did is I credited accumulated depreciation and then subtracted that from the cost of the equipment to give me the book value. And then what I told you is that this dollar amount, which is the book value, comes into the total assets calculation. So basically the net, because the book value has gone down, because accumulated depreciation goes up, book value goes down. Book value is the number that comes into calculating total assets. Therefore, total assets go down because the book value went down, because accumulated depreciation went up. Okay, so that's how this keeps the accounting equation in balance. So, quick recap. The journal entry to record depreciation is debit depreciation expense, credit accumulated depreciation. Accumulated depreciation shows up on the balance sheet. Depreciation expense shows up on the income statement. Accumulated depreciation is called a Contra asset account on the balance sheet. It is subtracted from the cost of the asset to give the book value. The book value is the number that comes in to calculating our total assets. Okay? Let's talk about unearned revenues. So we've talked about this some in some prior lecture videos, but I'm going to go over it again. So unearned revenues are also called deferred revenues. This is when we get paid in advance. We get paid in advance for future services. So maybe we're a legal firm and a client of ours pays us for prepaid legal services. They say, well, you know what? We're going to pay you $2,000, and over the next 2 years, if we do something stupid, we get in trouble, you're going to help us out. So we're paying you up front. That is unearned revenues. That unearned revenue is a liability. Because remember, we talked about liabilities as something that you owe, right? But it doesn't always have to be cash. It can be that you owe a service. That is also a form of a liability. You get paid up front. Now you have to perform the service. You have a liability to perform that service. Okay? It becomes a liability until the product or service is provided. So once we provide the service, we don't have as much of a liability because we provided the service. So once we provide the service, we've earned revenue. So once we provided the service, we have earned revenue. We no longer have the liability. Now we have revenue. And that's the adjusting journal entry that we need to think about doing here, is that when we are paid up front, we're going to debit cash, credit unearned revenues. But then when we provide the service, then we reduce our liability and we recognize revenue. Okay? So let's take a look at our example right over here to go through looking at unearned revenues. So right over here, our fast forward, December 26th, fast forward agrees to provide consulting services to a client for a fixed fee of $3,000 for 60 days. On this day, the client pays the entire consulting fee in advance. On 12/26, we have to do the journal entry to recognize that we got paid up front, because that's what's happening, right? Is our client is paying us all in advance. And then we owe them consulting services, so we have a liability. What do we get paid in? Cash? Cash is an asset. How do I recognize that an asset is going up, such as cash? With a debit. So on 12/26, I'm going to debit cash for my $3,000. Now, I have a liability to provide this consulting services, and that liability is unearned consulting revenue. Okay, I'll come over here and I'll say I'll credit my unearned consulting revenue for the $3,000. Unearned revenues. Now, why do I credit unearned consulting revenue? Because it's a liability. My liabilities are going up. How do I recognize that my liabilities are going up? With a credit. Why? Because of the accounting equation. The way to increase the right side of the accounting equation, liabilities and equities, with a credit. There's no deeper philosophy here, folks. That's all it is. Liabilities are going up. How to recognize an increase in liability? With a credit. Okay. So on December 31st, we have to recognize that we've earned 5 days worth of consulting revenues. Because from the 26th to the 31st, we have 5 days, and Fast Forward has provided 5 days worth of consulting revenue. We have to recognize that. Why do we have to do that? Because we have to recognize that we've earned revenue in this accounting period. Because of the revenue recognition principle. So what I can do is we can divide the 3,000 by 60. That gives us $50 a day. How much do they earn in December? Well, there's 5 days. It was 26th to the 31st. $50 a day times the 5 gives me $250. So on 12/31, I'll do my journal entry to recognize that we've earned $250 worth of revenue and that our liability has decreased by $250. Why has our liability decreased? Because we provided the service. Right? We had a liability to perform $3,000 worth of services right over here. But here, I fulfilled $250 worth of that. So I have a question for you. How do we decrease the liability? Debit. So I'm going to debit my unearned consulting revenue to recognize that my liability has gone down. Debit unearned consulting revenue for $250. Have I earned revenue? Yeah. It says right over here. I earned it. I performed 5 days worth of consulting. How do I recognize that I earned revenue in terms of debits and credits? With credit. Credit revenue. Why do I credit revenue? Well, because as revenues go up, equity goes up. And how would I recognize that equity goes up? Credit. Okay. So then I will credit consulting revenue for $250. This is my adjusting journal entry on the 31st, right over here. That is my adjusting journal entry right there on the 31st, okay? So I think what I'm going to do now is end this lecture video, and then in the next one I will talk about accrued expenses and accrued revenues, okay? Thank you so much.